Welcome to the Melbourne Property Podcast, hosted by Sky and Lindsay Hammer from Convergence Buyers Agents, your local property experts.
This podcast is your go-to source for insights, trends and tips on navigating the ever-changing Melbourne property market.
Whether you're buying an investment property or your dream home, stay tuned for the next 30 minutes as we give you exclusive insights that will shape your next property purchase. Let's dive in. Hi, I'm Sky and welcome to another episode of the Melbourne Property Podcast. Today I'm super excited about what we've got in store, not just talking property, but all things tax as well. And I know some people might think that sounds boring, but to be honest, they basically go hand in hand. I think you really need to have a good accountant on your side when it comes to property. So I'll leave it there for now, but as always, joined by my co-host, Lindsay. Lindsay, how are you today?
I'm doing pretty well. I think I'm like most people. I am nearing that end of year fatigue though. So I'm looking forward to a little bit of time off over Christmas and New Year's. And we'll see how we go from there.
Very good. All right, maybe over to you to introduce our special guest today.
Yeah, I'm super excited to have Gurpreet Padda from ClearView Financials here with us today in the studio. Now, Gurpreet specialises in property investors, so obviously that's going to be highly beneficial to all of our listeners with the Melbourne Property Podcast. Welcome, Gurpreet. How are you today?
I'm good, thanks, Lindsay, and thank you for the warm introduction. I'm really pleased to be here today.
Looking forward to chatting all things property and tax. I think there's a few different types of accountants. There's accountants who just do tax, and then there's accountants that actually get property. I think it's just a huge kind of force multiplier for anyone that's investing, or even, I guess, people that own their own property as well, that they live in. I think there's going to be a lot of interesting stuff to unpack today, so I'm really keen to get into it.
Yeah, and I also want to add, I feel like you're one of the most affordable accountants out there and the fastest for setting up a trust.
I love how we're plugging Gurpreet already, but honestly, yeah, if you need someone, if you're one of those investors that needs a trust set up, obviously there's a lot of, I guess, advice that comes around that as well. But you're right, you've saved us a few times and we've needed some trust set up fairly quickly for clients. So we'll get to that a bit later. I love how you already jumped into that. But as always, to kick things off, we start with our icebreaker. Lindsay, do you want to answer that one today?
What are you loving about Melbourne? I'm still going with the end of year theme. Like, I do love that there's all the Christmas things on offer. So over the weekend, we went to the Maya window. So there's the Christmas themed, I think it's Lego this year, which, pretty special. Later this week, going to Christmas carols in the park at Dendy Park. So that should be pretty good as well. What about you, Sky?
Mine's a little bit niche, I think, today, but in one of our favourite cocktail bars, I don't know if for some of the listeners know, we used to live in New York. Our favourite cocktail bar that used to be around the corner from us, Death & Co., actually just opened up in Melbourne. So world's best cocktail bar by some way, I would say. There's obviously some new ones now, but they've decided to open up internationally and they've chosen Melbourne as their first location. So super excited about that. Managed to check that out with a friend. And the bigger picture of that is that I love that they chose Melbourne, like of all the cities globally, but also even just in Australia, they picked Melbourne. And then the second one they've actually picked is Brisbane, interesting enough. So again, people skipping past Sydney. I think they're looking at the future where things are playing out in Australia. And yeah, Melbourne and Brisbane are the two they've chosen. So very interesting times.
Now, over to you, Gurpreet. We have this icebreaker. We talk about what are you loving in Melbourne right now. What are you loving?
Yeah, I'm really excited for summer. We kind of skipped spring in
we did
this year. So hopefully we, fingers crossed, we'll get some warm days.
We can only hope. So everyone listening, this is just a reminder that none of the information discussed today is considered financial advice. These are just general discussions and don't take into account your personal situation. So if you did find the discussion interesting and you'd like some more information from Gurpreet, feel free to reach out to him directly. We'll put all his contact details in the show notes. Maybe we'll get started, Gurpreet. We're talking a little bit about your business, what makes it different and how you got into the industry.
Yeah, so I got into industry in 2019, so just over 6 years of professional accounting experience, been working in a reputable NSW firm, and then as an active property investor myself, we understand the issues property investors face, whether it's from they're purchasing their first property or expanding a portfolio. So we understand their pain points and help them guide through those. So with the smart structuring, efficient tax planning, we would like to see our clients grow their portfolio in long term.
Yeah, and it makes sense because I think we speak to a lot of people, like a lot of property investors, and some of us, I think there's just a wealth of information out there now. So a lot of them already know what trusts are. They think they definitely need a trust and that's where they want to go. And then they speak to us and say, we're going to buy on a trust, but they haven't really spoke to an accountant yet. They're kind of they've done their own research, which is great. But then they might have an accountant that they've used since they were 18 to do tax returns. And I basically say to them, ask them these questions. If they can't answer these questions, or if they give this answer, then I know a few better accountants because there's so many still that, particularly the ones that want to kind of sell off house and land packages, and it's all about just tax depreciation and nothing else. They kind of don't get I guess some of the clients are looking to build out those portfolios. So yeah, obviously being an active property investor yourself, it makes it quite easy for you to kind of see what people are trying to do and then obviously help them to get there.
Yeah, 100%. We see a lot of clients came through to us and their accountants are advising them not to buy under a trust. And I just don't get it. But then, when we dig deep into the accountants is in late 60s. And I think, okay, they always, their whole life advised to purchase under their own name. They can't just move that away from that. And, obviously now that investors are looking into borrowing power, asset protection and all these other options trust has to offer, a proactive accountant is always helpful.
Yeah, exactly. Yeah. You got to, like things change so regularly. And like we've seen it again, even on the lending side, what's happening with trust lending at the moment, like things change so often that you can't just have a default answer of yes, use a trust or no, use a trust. Like it changes. It feels like weekly at the moment, to be honest.
And I think that's a great way of describing sort of what you do as being proactive and staying across what's happening in that space.
Nice easy one to maybe kick things off in that sense is like, when should someone engage you as an accountant if they're looking to buy property? Should it be after they've just spoken to their mortgage broker, or is it straight away? Like, where do you kind of, if you get to choose, when do you want to jump in on that process?
Well, I would say ideally when they start thinking of purchasing a property, even if their first property, that's when you should start engaging, have a conversation with an accountant. Because it's not, a lot of people think, they can do they can manage their one property on their own and do the right things, but it's not quite, right, because once they get to third or fourth, then at that time they realize that, the mistakes they have made in the first one or the second one. And it's not about, setting up a trust on their first investment property. It's not always that. Sometimes it just comes down to structure is not always, about trust companies, SMSF. It can also comes down to, let's say if one partner earns 300K, another one earns 100K. So the advice would be to purchase under the one who's highest income earner, because you get the most tax benefit under their name. So it's these little things. So, you gotta set the foundations right.
No, I completely get that. Yeah. And like we've done that. We've got a few properties in personal name together. And then like you go through different periods where like in Lindsay's case, going on maternity leave and income changes, and you don't have to know that up front, but at least have that discussion and kind of work out, well, maybe what looks best both now, but also maybe going into the future in terms of income levels and how that might affect things going forward.
I guess generally, what are some of the things that people should be claiming as deductions, or when they come to you see people are forgetting about? What are the most common ones?
The common ones, if the property investor is trying to do themselves, one of the biggest, and is also under the ATO's radar, is interest payments. So the mortgage broker may split the loans from the PPOR into investment property, and they either miss that deduction or overclaim. And overclaiming is a problem with the ATO, and missing that means that you're leaving a lot of money on the table. The others which are usually gets missed is borrowing costs like LMI and any costs involved in setting up the loans. So these are things that the accountant would know. Some of the other adjustments we see is the settlement statement adjustments. So, for example, council rates, water rates, or land tax. When let's say, for example, someone purchased a property on 1st of May, and the previous owner has already paid the rates for the June quarter. So the conveyancer will do an adjustment on prorated basis, and it is a deduction, upfront deduction in the year for whoever is purchasing the property. So these are the things which we see that investors miss, whereas a proactive accountant will pick these up.
We have to go back and check a few statements properties we've purchased to make sure we haven't missed some of those ourselves. That's
I do remember our accountant came back to us on one of our loans saying, this financial year you've paid significantly more on interest repayments. And I was sort of like, well, yeah, the interest rates have gone up significantly and that's what's reflected. So even just staying on top of things outside of tax advisory, like interest rates would be really important too.
Yeah, I think another one you're talking about now, where I think we're probably 5-10K cash flow positive on one property. I think the next year was
Not
40-50K negatively geared, just because we went from like the 2% interest rates up to like 5 or 6 or whatever it was. Yeah, it does fluctuate. I want to break down some of the individual items. So you did mention LMI. LMI is an interesting one. So just to give an example, let's say we go out and purchase property, 650K, 10% kind of deposit, and let's call it like LMI of $10,000. What can you claim kind of straight up in terms of that LMI payment, and what can you kind of claim over the years to come? Are you able to break that down just as an example?
Yeah, sure. So LMI is a borrowing cost. So it will be claimed over 5 years.
Okay.
So it's not what exactly from $10,000, but depends on the date of the transaction. So let's say for $10,000 claimed over 5 years, it will be $2,000 a year. But not exactly. It will be prorated based on the days. So if the transaction has occurred on 1st of January, you'll be able to claim $1,000 in that year, and then $2,000 every year after until it runs down.
Okay, yep, that makes sense. Yeah, and the one we probably get the most is buyer's agency fees. So if you're an investor, you go out and buy a property using a buyer's agent. What can you claim? Can you claim it? Are you able to break that down a little bit? Because I get that question a lot. Obviously, when we speak to new clients, what they can and can't claim, and I obviously say speak to your accountant. But again, generally speaking, what does that look like for most people?
Now, this is a very interesting one, and probably a unique one as well. So I'll say this is a really good question. It is 100% deductible. But depends on the timing. It's really, when can you claim it?
Yeah.
So if most buyer's agent fees would become a cost-based item, so which is deductible when you sell the property, it becomes part of your cost base. But if someone has already owned 1 or 2 properties, or at least, one property, and they comes to a buyer's agent and to get an advisory session with you guys, let's say for, they just wanted to see what can they do in the next 10 years or something, but not trying to purchase a property, and you charge, 2 to 3 grand or whatever that is, that is instantly tax deductible in that financial year.
Okay. Yeah, that is interesting. So that's kind of more seen like as improving the portfolio, learning, getting advice to kind of how to grow the portfolio, grow the income and that kind of way. So yeah, I guess it's a good tip for people. Obviously, speak to your own accountant or just come and speak to Gurpreet. But yeah, that is good to know, because I know for us, that's how we're going to do. We break down and we have like a fee for the strategy session that's paid up front, an engagement fee, and we obviously have a success fee as well. So it sounds like that strategy session kind of engagement might potentially be deductible in that first year after purchase if they already have an existing property.
And you've got a good accountant.
Yes, yeah, that's it, yeah.
Any other specific costs you want to run through?
Like land tax. I know it's claimable. Is there any kind of tips, tricks covering land tax as well?
No, it's pretty straightforward. It'll be claimed as your council rates and water rates. It'll be claimed in the same year.
Yep.
So yeah, pretty straightforward in that one.
And the other one that I know, we've got this property in Brisbane it's I'd say our best performing property, but
for
capital growth. Like it's gone up significantly, but there's always something popping up, and we're always bordering that line of repair versus improvement. So with general maintenance, like we'll have like obviously there's hot water systems, that type of stuff, but when we have to kind of almost do small renovations of say a kitchen, for example, where do you draw the line on what's I guess a repair and then what's an improvement? Because obviously they're treated quite differently from a tax perspective.
Yeah, and it's actually a very common question asked by a lot of investors. They're trying to claim the capital improvement, where they think is a repair.
Yep.
So we got to draw the line. So the regular wear and tear of the property. So any plumber's going to change the tab, or just if there's a broken tab or something. So regular wear and tear comes under repairs. Whereas if you're trying to improve the asset value, that will become a capital improvement and will be depreciated over time. Now, some of the items could be, very fast depreciation, like, could be a dishwasher may be claimed under 7 years, whereas, if you're trying to do a renovation or a rendering or something, which is part of the structure, that's depreciated slowly over 40 years.
Yep.
So it really depends on what we're trying to do here.
Yeah, it's quite different. Yeah.
I was going to ask about traveling. So this is one, like, I know the answer to it, but it's probably good for our listeners to also hear. If you're purchasing an investment property interstate and you're not using a buyer's agent, or maybe you are, but you still just want to travel to that location to check out your investment property, maybe do a walkthrough, actually see it with your own eyes, is that something you can claim as a tax deduction?
Unfortunately not.
Unfortunately not.
Yeah, but it is a lot of talks. There are a lot of talks, and a lot of property investors think that they can claim. But it was available deduction for many years. Only stopped on 1st of July 2017, and that was also because a lot of investors were trying to misuse it, and hence we all have to cope with it. And now we can't claim it. It's pretty much for residential properties. Commercials, there are different rules.
Mm-hmm.
Okay, yeah, but again, sounds like another one of the baby boomer specials that they rotted the system and had all the fun, and then obviously they've lost that one now. So it makes sense. So like I know personally, and I hope the ATO is not listening, but I mean, if that was an option, we'd be buying properties in holiday destinations all over the place. But it makes sense why they got rid of that, because I'm sure people were eroding the tax system there for sure. Yeah.
And you touched on earlier a little bit about depreciation. Can you speak to that in a bit more detail? Like if someone gets a depreciation schedule, how does that play out from a tax perspective?
Yeah, sure. So depreciation is a really good tool to boost your tax refund. So it is basically the ATO lets you depreciate the value of the building over 40 years. And plant and equipment, your dishwasher, including your carpets and curtains, are depreciated on a different rates. But generally speaking, it'll be about 40 years. And it's still, if you purchased a property for $600K and the $300,000 is kind of the building and plant and equipment, you still get really good depreciation report. So depreciation report is prepared by a quantity surveyor, which you can find online, or we obviously buyers agents, accountants all have contacts. We can share that. Once that is done, it's a one-off for one investment property, and investors get a deduction every year afterwards, usually about 40 years, as we discussed earlier. And it's a non-cash deduction that they can claim and get a tax refund every year. So it's a really good tool for you to use.
Yeah, and we encourage it. We don't speak about it a lot. Obviously, it's more of an accountant's domain, but we do have a preferred quantitative survey that we use, and we just say get the report because you're crazy not to. And we're talking, I think, $500-$600 to get a report done. But then those, I guess, the deductions you can claim are $3 up to say $10,000. We don't buy a lot of new stuff, so it's usually in that kind of $3 to $10,000 window. But you can claim that every year, and that's as you said, it's a non-cash deduction that again makes your tax return look a lot better when you're bringing that in. You're getting 30-40 cents on the dollar back from that as well. So I highly recommend it. We could probably talk about depreciation reports forever. We might have to get a quantitative survey on as well. So
I was going to ask, do you get many people come to you as new clients that don't have a depreciation schedule and they've never heard of it? They've been sending their tax returns in without one for years, and they've got investment properties?
First-time property investors,
Yep.
I would say 100% of them don't have depreciation schedule.
Interesting.
They're missing out on so much.
Yeah.
So they come to us, trying to lodge their tax return, and we would say, where's the depreciation schedule? And that's the time then we start the conversation and we book the appointment with them, for the depreciation quantity surveyors to do the depreciation report for them. But then we do get property investors who have one or two properties, mainly in that space, and they've been lodging themselves and never claimed depreciation on the property.
Yeah. Yep.
Because the myths of that they still have to pay it back in the CGT, which we will cover down the track.
Yep.
But that myth that they'll have to pay back anyway, so what's the point? And we usually encourage them to get it as soon as possible because you don't want to miss on those deductions.
Yeah, and I mean, I know particularly if you're looking back the last 10 years, like $2,000 or $3,000 in your pocket 10 years ago versus what it's worth these days after inflation is quite different. So, yeah, interesting that some people do that. And I think we are looking for a new sponsor come next year, so maybe we need to get someone that can help in the depreciation space. If anyone's listening, feel free to reach out to the next year. But yeah, it's an interesting topic, and I often take it for granted. Like when clients ask about it, I realize I skip over it sometimes because I'm just like, get this report, it needs to get done, and then maybe not kind of unpacking it enough. So that's good to hear. And I think, if anyone listening, go out and do that. Google it, check it out, and then find someone local that can do it.
And it's not just for newer builds, like even properties built before 1987. Most of them have had some kind of update, and generally it works out in your interest to get it done. So
Yeah, even a lot of clients who purchased properties in Queensland or WA, and they would say there's no point getting the depreciation report because this property is very old, and the depreciation, the quantity surveyors we goes to, they would check for the client an estimated. So what's the value they can get before they even pay for it.
Yeah.
So we usually, encourage them to, okay, let's have a chat, and if you think this is beneficial, and 100% of the time, they will then get a report because it's more than what they expected.
Yeah. I was going to ask as well about stamp duty, so whether that's something that you can claim, because we do have a property in the ACT and I know it's different there. So are you able to step us through whether that's a tax deduction?
Yes. So stamp duty overall, yes, it is 100% deductible. Again, about the timing. So in other states, all other states except ACT, it is deductible, when you sell the property, so it becomes part of the cost base. Whereas in ACT, it is tax deductible in the year you pay. So,
I wonder if that's because ACT, it's technically a 99-year lease, so the stamp duty is treated differently.
Exactly, that's what it is. So because it's not, it's a 99-year lease.
Yeah, you don't really own it.
Yeah.
What are some of the potential clawbacks or adjustments that people should be considering when they're looking to sell a property?
Mainly regarding that, depreciation is also a myth that they have to pay it back all. But yes, depreciation does reduce the cost base of the property. So if, for example, property was 600K, 300K was the building value, they have claimed now, after 10 years, they have claimed $50,000 of depreciation. Now, the cost base would be 250K for that property, obviously ignoring all the other facts of stamp duty and everything else. So they need to pay CGT on that. But however, it is still beneficial because they're going to get 50% CGT discount. So they're not paying tax on the whole 50K of depreciation. They're only going to pay tax on the $25,000, which is where the benefit lies.
Great. Yeah. We might move on to another topic that a lot of listeners will be interested in, negative gearing. So obviously every investor's situation is different, but why do so many investors, particularly those higher income earning investors, want properties that are negatively geared?
Yeah, so we are very lucky here in Australia that we have negatively gearing. It is allowed. It's not every country, by the way, for the listeners.
Yeah.
So for the high income earners, it just makes sense because their tax rates is 47%. And with the negative gearing, basically what it means is, your property's total income minus all the expenses, minus depreciation, whatever the loss is, you can claim against your taxable income. So for the high income earners, it's 47%, which makes it very useful for them, and they get that tax refund in the year. Whereas obviously, as we discussed, depreciation is a non-cash expense. They hadn't spent that, but that they gets that money back. So going into a bit more detail, let's say a property costed them $10,000 in cash basis, and is $5,000 worth of depreciation. Based on their tax rate of 47%, they're going to get $7,000 tax back. So the actual holding cost in cash terms is only $3,000. And hopefully they have, purchased a really good property using you guys. And that property has, gained $50,000 to $60,000 or more in some terms. So that's where the value is, that, you paid $3,000 in a small, tax effective way, and, gain that 50, 60K in unrealized capital gains.
Yeah, and I think Melbourne's a really attractive market right now, obviously from a capital growth perspective, but also because the yields are that little bit lower, there is a tendency that, I guess, from a negative gearing point of view, you can do quite well. We have a lot of, and actually listeners like doctors, medical professionals based in Sydney that are just buying up property in Melbourne at the moment, and a lot of them are all buying a personal name, like obviously there's asset protection and trust and other things, but I think there is an appeal, particularly when you creep over that $1 million mark. That the negative gearing benefits, while getting really strong capital growth, do, I reckon, almost like a kind of force multiplier for some people. It's a really kind of, I would say, common trend we're seeing at the moment, people looking to do so. Yeah. And a lot of it is based off the advice of accountants saying, like, you're paying hundreds of thousands of dollars of tax again, you need to go buy another property that's negatively geared. So, it's interesting to see what's happening at the moment. Somewhat related to this, and then this is not, now we're not just talking about high income professionals, but I guess people with multiple property portfolios or even one maybe negatively geared property, the variations, can you explain more what they are and how they work? Because I think this is one for maybe first time investors or even people just not familiar with it. It's something they could definitely take away and implement straight away.
Yeah, 100%. It's not one of the it's not very well known topic in these property investors, and especially, as you can imagine, a lot of people are struggling with depreciation reports. Mm-hmm. The PAYG withholding variation is something very unique. Mm-hmm. So yeah, we how it works is, as we just discussed earlier, like, with negatively gearing properties, people get tax back. Mm-hmm. So let's say in that case, someone is entitled to get a $10,000 tax back in the year at the end of the year, rather than waiting for the 12 months to get that tax refund back. What an accountant, or they can do themselves as well, but an accountant will be able to help them better. What an accountant can do is project those figures to say, this is how much the loss is going to be, and this is the tax refund they will be entitled to. And that we will be able to lodge a PAYG withholding variation with the ATO. And rather than waiting for the year end, they'll get their tax refund every pay cycle.
Yep.
So in that case, let's say $10,000. So roughly they'll get $200 back every week. Mm-hmm. It just helps them with the cash flow on the day-to-day basis to sustain those holding costs.
Yeah, and particularly for, say, small kind of medium-sized businesses or small business owners as well, it helps with cash flow. It also means there's less money you're paying your bad statement to the ATO up front as well, and that type of thing. So definitely something to consider. And again, everyone's situation is different, but I'd recommend at least looking into it with your accountant or Gurpreet, as I said a few times, because I think it's definitely one, you're right, like not many people are doing depreciation reports, but then I think even less are doing the Section 66. So definitely something to check out in a bit more detail.
Yeah, I would definitely recommend, speaking to a property savvy accountant because your regular accountant's not going to go dig deep into these things. Yeah. Whereas a property savvy accountant like us, we do this day in, day out. We just do it for a lot of investors. And it's just, next thing in our mind that, okay, rather than waiting for the tax refund, we can do this. And depreciation reports should be done on time. Whereas, this is all we call is a proactive accounting.
Yeah. And I guess if you're someone that gets that 10, 20, 30K, even sometimes tax refund, it's much better to get that throughout the year. Instead of you just getting this big lump sum 12 months later, it would make a lot more sense to be getting that kind of couple of grand every month. And obviously with the inflation the way it is and just the numbers and like if you run it, what it looks like from, I guess, financial point of view, it makes a lot more sense to get that money up front than waiting, letting the ATO generate the interest on it at their end.
100%.
Can we talk a little bit more about trust structures? So I think a lot of our listeners will be familiar with it, but can you talk generally sort of what are the benefits? Why do people go down that path?
Yeah, so a trust is really a legal structure that you could buy a property under a trustee's name for the benefit of beneficiaries. So why a lot of people are using it these days is mainly for, I would say recycled borrowing power, but then there are other ways that, you can use it. Obviously, asset protection is key for some of the clients, who working in a high risk job or running a small business which is risky. Whereas for some people, it's about tax flexibility. So how they can distribute the funds to the family members. So, for example, if you buy a property under a trust and you can distribute the positively geared income from it, or down the track capital gains to yourself, to your wife, or to your children if they are, over 18 years of age. So it really gives them that flexibility of, who will receive the distribution, especially if they are the high income earner.
So, for example, with the children, it might be they are in a lower income bracket, and so the tax rate's going to be better?
Yeah, 100%. So, even people can start planning way earlier. Like, say, if the children are only like 11, 12 years old, but they're not thinking of selling the property for the next 10 years. And at the time, like in 10 years, they're like 20 years of age and they're still in uni. So they're not earning high.
Mm-hmm.
So rather, they can also use their tax-free threshold of 18,200, but also the low income, lower tax thresholds like, up to $45,000 or even that space. So rather than paying 47% of tax under their own name, they can use tax-free threshold 16% and then 32%, which is, it's all about tax-effective structure.
Exactly.
Yeah, and I think a lot of people, when they think trust, they think about that kind of, let's call it unlimited borrowing capacity, like TikTok and others are pushing quite a lot. I'd say
People on TikTok.
But the other thing, we're looking for another purchase at the moment, and for us, when we're looking to purchase in trust, one, probably asset protection, obviously the borrowing capacity piece, but the other one is because we're not looking at it next, say, 12 months, we're looking over the next 10 years. And this purchase we're looking to make is to add a grading flat on the back or even potential subdivision. So again, although we might miss out on those negative gearing benefits in the kind of next 2 to 3 years, we are planning to do some form of development on the property. As I said, whether that's grading flat, subdivision, that kind of thing. So we were expecting to get to cash flow positive quite quickly with that increased income. And again, I guess the way you can get us to disperse that profit when we get to that space makes a lot more sense for this kind of structure as opposed to personal name, even though we'll lose some of that negative gearing benefit up front.
Yeah, 100%. Well, I know trust with these lending changes, people are a bit scared about trusts as well. Mm-hmm. But it's, as you said, it's not only about short term, like, we're looking at 2 months, 12 months ahead. But that's you can think about, in recycled borrowing power.
Yep.
But asset protection, it's a lifelong thing. Mm-hmm. With the tax effectiveness of, you have the choice to distribute income. That's obviously, a long-term thing as well. Mm-hmm. But even you're thinking 20, 30 years in long-term, if you really want to go ahead that way. There are people who would like, to buy and hold the property for 30 years mm-hmm. and have that in their estate planning as a part of their estate planning.
Yeah.
So, you can give the control of that property without paying the stamp duty and all the other costs.
Yep.
So, yeah. which obviously, let's say if you purchase a property now at 800,000 in 30 years' time, that would be like in millions.
Yeah, yeah.
And paying the stamp duty on that would be, wouldn't be ideal to transfer that property under your... Yeah. Or to give the controls to your children.
Yeah, I mean, it could be 800K in stamp duty.
By that point.
Particularly for a still under the current government, I think, in Victoria, by then it could be, that's what we might be paying. So we'll wait and see. But I think it's useful for people to broaden out, I guess, what the benefits of trust. Obviously, there's the flip side, there's some cons to it as well. But I think, it's not just one thing. There's multiple benefits for that kind of structure.
Could you actually talk through some of the cons or the negatives behind using a trust structure? Like, when is it not suitable to use one?
So, I would say, a lot of clients come to us and they will say, can you please set up a trust for me? We usually go through a quick advisory session and try to, figure out why they exactly need it, because it's not the right fit for everyone. And obviously, there are the cons are like, first of all, the losses are trapped under in it, but obviously, depends on what they think of in the long term. What's the exact plan is, if it's estate planning, then they don't care about the short term losses trapped into the trust. So most properties, I would say, they will become positively geared within 5 or more years, but depends on, how proactive are you with this. But and then you can obviously utilize those losses in the trust. So that's one of the con. And the other one would be, the setup cost is obviously more around, $2,000 plus. That's where it starts from. And the running cost of it to do the tax returns and everything, it's more expensive than doing under your personal name.
It's not as straightforward either.
It is a complex structure, hence it costs a bit more. So with your obviously if you're purchasing under your own name, it's part of your tax return plus a rental schedule for each property. Whereas trust has to have its own tax return, financials, and then potentially an ASIC fee. And then a letter for a bank to say, how it is doing every time you try to get a loan. So the accountant has to put a lot more effort into it.
I feel like it's every week I get an ASIC fee invoice. Like it seems like, and it's not, but I don't know. Is it July 1 or is it when you set them up, or like every time I get an email from an accountant, it's like, oh yeah, ASIC fee's due again. I was like, I swear we just paid this, but I mean, different businesses, different properties, all that kind of stuff, different trusts. But yeah, they love grabbing that couple $100 every now and then.
It's currently $329.
Yeah.
And it's every year from the date of when you set it up.
Okay, yeah, that's why it seems to be all the time. It's not,
so
July 1.
Maybe you could be a bit more strategic in when you set up all your different trusts, Sky.
Exactly, yeah.
So speaking of trusts, you mentioned it's around $2,000 sort of generally to set one up. How quickly can that be done?
So generally, we try to get this done within 2 to 3 business days.
Wow, that's really quick.
I know, because we understand, the property deals, how quickly, these can turn into a problem when the structure is not there. So a proactive accountant will obviously, help you to set it up. So that's where we comes into play. So 2 to 3 business days usually, and starts from $2,000, as I said, the cost is, but depends on which state you are. Again, NSW, they're going to pay the bit higher stamp duty. But other than that, around $2,000 mark.
Okay. Yeah, that's good to know.
Good to know.
And I think, and that 2 to 3 business days also is, I guess, factoring it, the person you're setting the trust up for does the paperwork, signs it, gets it back to you quickly, because I know that sometimes that can be the delay in itself. It's just getting that kind of paperwork done and that type of thing.
That's right. They need to, sign few documents and a few different times. Obviously, we'll need to first set up the corporate trustee. They need to sign those documents with the ASIC, and then we set up the trust, and then we go through to the ATO to set up the IBN and TFN. So there's this process that we have to follow, and it's step by step.
Yeah.
And then the ATO does take some time as well, issuing ABN in some cases. So that's where kind of a delay as well.
I think we had one instance where usually they're very quick with the ATO turning them over, but it's like every so often there'll be one that they review and it takes like a month.
Yes, that's right.
Like just by chance, you might be that unlucky person that gets that.
They do say that when we first set it up, that trust, they initially said 28 days, but it was then actually was handed out within about 7 days.
So is that just a review process that the ATO will randomly do?
Sometimes we see the main problem usually is if the person has changed their names or the name does not match with the driving license name or the ID name does not match with the ATO, and then it just flags, and then it'll take 28 days.
Okay, so get your personal ID documents in order before you go to set up your trust.
100%.
Let's talk capital gains. So obviously they're treated differently whether you're an investor or you're looking for a house to buy to live in yourself. Maybe just as a high-level overview, are you able to talk about the differences and how they're treated, particularly on selling the property, let's call it in, say, 10 years' time? What does that look like for a homeowner versus an investor?
Yeah, sure. So homeowners are very lucky, and especially that's, again, one of the advantages we have living in this lucky country.
Yeah.
So there is no tax payable on if you sell your principal place of residency. It doesn't matter how much gain you have made.
Yep.
Even, just to add there, if people, sometimes live in that PPOR and then they move away to interstate or they move to the other to overseas, and you have that option to select that the 6-year rule. There will still not be any tax payable on that principal place of residency as long as you don't claim any other house as a main residency for those 6 years.
Yeah, it's funny, like we're in that situation ourselves. We were rent vesting. We previously bought a house that we lived in, but like particularly the Melbourne market, it's just such a good rent vesting market to be in. Sydney is obviously the same. The rents are cheaper, relatively speaking, to what it would be to pay off a mortgage. So we're rent vesting now. I'm tracking the market and making sure we've still got that 6 years because we will sell off that property at some point and either potentially buy another own occupier then or just buy more investment properties. But again, that 6-year kind of freeway that you have to do so makes a lot of sense for a lot of people. And then it's just kind of timing your exit out of that market to take advantage of that, I guess, that free capital gains.
Exactly. It's just, what you know and how to use these for your advantage. And kind of like I'm actually in the same situation. We got a property in New South Wales and we are investing here. But it'll be under 6-year rule that it'll still be, tax free.
Yeah, exactly.
So just to clarify with that 6-year rule, it's you live in the property, then when you move out, you've got 6 years from when you move out or 6 years from when you first bought it?
So 6 years from when you move out. So, and then, you can pretty much rent vest for 6 years and sell the property and it is still tax free.
Yeah, perfect. We have a few clients, and this is, I guess, another interesting example to use just to kind of get your advice on it, is that we have a lot of clients, obviously with the 5% deposit scheme that's come in. A lot of people, let's say they live in the northern suburbs of Melbourne, they still just want to buy a unit in northern suburbs of Melbourne. That's just what they wanted to do, and they're doing it. There's another school of thought, though, and we've had a few of these people as clients recently, and including one right now, where they're like, you know what, I'm happy to go and move to somewhere on the fringes of Melbourne or somewhere where I don't want to live long term, take advantage of that kind of 5% deposit scheme, but buy something that's going to be a much better investment. And they're basically doing that, living in that for, let's call it 6, 12 months, whatever they need to. And then they're planning to go back and rent where they want to live again. So it's essentially be kind of temporary homeowners and back to rent vestors, and then also potentially taking advantage of that six-year rule as well in the future because they have lived in it and then they've got that 6 years. Is there like a minimum amount of time you need to have lived in the house before claiming
that rule?
Ideally, I would say about 12 months.
Okay.
Because it's not usually, if I have seen these, other people have done this in Brisbane as well. So they moved from Sydney to Brisbane just for this reason. Lived there. And obviously, they have done really well. But 12 months is ideal because also if they're getting, it also meets the other state government requirements of, the first home buyers grants and everything. So 12 months is ideal in that space.
Yeah, nice. Okay, perfect. That covers off, I guess, homeowners really well. What about, investors? What does it look like for them? They've held a property for, say, 10 years. What does that kind of, tax process look like when they sell?
So, they get 50% discount, which is very famously known as, and most investors know about this. But they get 50% discount on the capital gains. So, for example, they purchased a property for $500,000 and they're selling it in 10 years' time. They're selling it for 1.5. The total capital growth they have earned or the profit they have made is, let's say, 1 million. Obviously, ignoring the agent's fees and stamp duty and all that for this argument's sake. So that $1 million, they will only pay tax on $500,000 on their marginal tax rate. So hopefully they have, set up the right tax structure and or a tax effective way to minimize this.
And that's a good example as well of like, let's say they bought in personal name and they're both now high income earners, 250K spread across two people potentially. That's taxed at that 47% or whatever it's going to be in 10 years' time. I don't think it'll be much less, if not probably more, versus whether let's say they bought that 500K property in a trust and they've now got kids in their 18, 19, 20 years old. Very different picture when it comes to, I guess, what the tax they'll be paying at the end of the day.
Yeah, 100%. The best way I would say, people do come to us and they'll say, we're trying to flip a property and it'll only be like 6 to 7 months. We say, that should not be the case. Hold it for 12 months. So to answer that question, best way to do it is holding the property for 12 months. And then the second one is, if you have structured it right, then again, you could holding it under a trust or something. Then you can distribute the profits to the children in that when the right time comes.
Are there any other ways that people can minimize their capital gains tax? Any other strategies that you can put in place?
Yes, as we discussed, 12 months is the holding period. That's the best strategy. Then the structure. The third one I would say is selling the property in a low income year. So if they're going away on holidays, maybe around Australia or Europe, and they're not
taking 6 months off or something.
100%, especially when you have that cash coming in. So selling in that year, obviously make sure your contract date, not settlement date, contract date is in that year. Selling that property in that year will obviously reduce your tax payable. And the fourth one and very important one, I would say, is superannuation. So people can transfer money or into their superannuation and use the benefits of 15% tax rate under super. So for example, let's say the capital gains is $500,000 after discounts and everything, and they then pay that off $250K each to husband and wife. That is only taxed at 15%. Now, people may be thinking that the limit is only $30,000 per year. How can we contribute $250? So this is what we called unused cap carry forward. So with superannuation, they let you whatever superannuation you hasn't contributed in the last 5 years. So every year you get a cap. Some years it was 25,000 and then went to 27,500. Now it's 30. So the gap between the superannuation cap and the superannuation contribution is carry forward until 5 years, as long as your superannuation balance is under $500,000.
Okay.
Yeah, and like we utilised this earlier this year. We actually sold off one of our properties that we were kind of moving around. We wanted to free up some cash. We had some really strong growth from it over a very short amount of time, so we wanted to pull that out. But then it was finding the balance between how much we want to put into super to minimise, obviously, the capital gains, and how much we want to free up that cash to use for a different investment as well. So it's a really good one. I don't think a lot of people are tracking that. But again, if you've got a property-savvy accountant, it's definitely one that you should consider. And I guess maybe save up those contributions for if you are looking to sell in the next few years.
I was going to say, I think it's interesting that you mentioned going off the contract date as well, not settlement, because we had a family member who went through something similar where they sold, I think it was in like May, June, but then it didn't settle until in the next financial year. But they wanted to reduce their capital gains tax and put money into super, but they didn't have the cash from the sale. The property hadn't settled yet. So they had to find those funds through other means to then put into their super to reduce that capital gains tax. So you need to be thinking about all of those things. And I guess that's where an accountant like yourself, where you can have that overall strategy and help plan things out, is really helpful.
Yeah, and it's not always the strategy with your accountant is not always when you're trying to purchase. It's at every stage, and when you're thinking of selling, you should have this conversation with your accountant about the dates. They're really important. You sell a property on, let's say, 20th of June 2025. The tax is payable on 15th of May 2026, and you sell on 1st of July, tax is payable. So 10 days difference there, but then 12 months difference on tax payable. The tax is payable in 15th of May 2027.
Yeah.
So you're really you can delay that tax with the 10 days difference, but also as you said, you need that cash flow to be in. So if you really wanted to sell in the year, then probably have the settlement date before kind of 15th of June at least, because then superannuation takes time to be processed as well.
Yeah. Okay, so I guess one thing we haven't touched on throughout this discussion yet is self-managed super funds. And obviously for a lot of people that are looking at different structures and minimising their tax, self-managed super funds is one path that they often go down. So we haven't talked about that. Are you able to explain a little bit why?
Yes. So that's right. We haven't talked about this, but at ClearView Financials, we are specialists in property tax structures, tax planning, but we don't do self-managed super fund. We have other partners that we deal with day-to-day basis. They are really experts in that space, and we leave that space we leave their expertise to deal with SMSF.
There's a lot of compliance, so it makes sense, going to an expert for self-managed super fund and going to an expert when you want that property investor-related tax advice.
That was a lot. We covered a lot in that episode. So thanks again for coming on, Gurpreet. It was great to have you here. If people want to contact you directly, I know we have a lot of people that reach out to our guests kind of after the episode. We'll make sure all your details are in the show notes. But is there any other way you'd like people to reach out?
Yeah, I would say via our website, and then there is a booking appointment. They can book appointment directly with me, and happy to go through any questions they have. And we also have a special promo code for Melbourne Property Podcast.
Yeah, very good.
Great. So people need to mention a special code. We'll include it in the show notes for everyone.
Awesome. Perfect. Yeah, thanks again for coming on, and look forward to chatting soon.
Yeah, thank you very much for having me. This is great.
Thanks, Gurpreet.
That's a wrap for this episode of the Melbourne Property Podcast. Just a reminder that this information is general in nature and should not be considered financial advice. If you'd like to discuss your personal situation, book a discovery call with the team at Convergence Buyers Agents. Our link is in the show notes.
If you learned something from this podcast, hit subscribe and never miss your fortnightly dose of Melbourne property insights. Catch you next time, and happy house hunting!